private companies that want to grow invariably need capital.
You don't just want to make these businesses bigger though, you also try and make them better, so that ultimately you earn a higher value for them when you eventually do sell them. How do you do that? How do you make a business that's already pretty good because you've invested in it better?
We won't spend money for the sake of it, and nor will our company partners. And these private company owners are very savvy business people. You know, I think the bulk of business expertise lies in the private company world. And look, that's because there's more of them. In round numbers, about 1,000 private companies in New Zealand that we really like. And
Go on, give me the top 10.
No. We wouldn't invest unless we had inside information. And in the public company markets, it's
illegal.
It's against the lawyer.
Is direct capital a net buyer or a net seller in this environment? Like, what are you thinking about going forward? Is this the year of buying or selling? We're in Omaha, a beach town an hour north of Auckland, to meet with Ross George, the pioneer of private equity in New Zealand. 30 years ago, he and two mates started Direct Capital. It's invested in iconic companies, including Wet and Forget, AS Colour, Bayleys Real Estate, Rod and Gun, Pink Bats, Becca, and many more. Their deals often go unspoken about because they play in private, but today Ross is an open book. He's invited us to his badge to discuss everything, from how he wins over business owners to the price it's willing to pay them, stories of its success, and more difficult deals. This is the full unedited interview, and I hope you enjoyed this conversation as much as I did. Well, thank you so much for having us in your beautiful home in Omaha.
Thank you.
It's stunning.
Yep.
You've pioneered private equity. You've been in it for decades, dare I say. When you first started in private equity though, especially in New Zealand, I imagine it was very different. You were asking investors to give you millions of dollars. Your first fund raised, $53 million?
Yes.
And you didn't even know what businesses you were going to buy with it. So you had to ask them for millions, not quite tell them what you were exactly going to allocate it to. They must have thought you were wild and crazy. But look at it now. I mean, it's clearly worked. You've raised hundreds of millions of dollars and allocated it now. So over that time, what's changed in private equity?
Look, a lot and nothing is the answer. First of all, we raise funds. We still are unable to tell ourselves or our investors when and in whom that money will be invested and who we'll partner with. So, the reason we're still in business is we've done it responsibly in the past, and so we can go to our investors and say that, and we have done just recently. So that's what's not changed. But the investors do a lot of work on your processes, your integrity. If you don't have a good financial track record, you're not in the race in any event. So that's still the same. And I know it sounds funny that you go out and ask for money and it goes into a black box and you learn what it's gone into before. But our investors know us. They, as I say, they know we've got good integrity and good systems. The second thing is they now know how big this private company market is, and they've met a lot of the people in it, and they know there's incredibly successful businesses. So if you tie that through, it goes into a black box, but those people are honest and good integrity, and I know there's all those companies out there. It's much less of a risk than you think. And so that part hasn't changed. What's changed since we started is there wasn't this industry in New Zealand, and in fact, Mark and Bill and I started the business, and we were all new back to New Zealand ourselves. We'd, like a lot of people, we'd had our careers offshore. We came back in our early 30s, so we were three new people asking for this, but we were able to point to how private equity worked offshore. And look, everything happens in New Zealand that's worked offshore, doesn't it? That's
the playbook's there. You just got to look at the rest of the world.
That's right. And but there were lots of reasons not to do it from trustees and things like that. They've all gone now because we had our 30th birthday party in October last year.
I heard. Happy birthday.
Thank you. And it wasn't mine personally, but
I'm sure it felt like it.
It did.
Just as big a celebration.
It did. And so we've been around a long time, and it works. And there are other people in the industry now. There wasn't when we started off, so we had to explain what the industry was as well as those other risks. So it's quite an appealing thing for companies, and it always has been. So that's never changed either. Private companies that want to grow invariably need capital, and the banks don't give it to them.
So if we consider some of those companies that you've bought, especially in those early days, Ryman Healthcare, Sky City, NZ King Salmon, Scales Corp, all pre-IPO, they're now large listed companies on our market, but you were in early on all of them. So what tells you that something is a fantastic business, even early on, before it's big? And what do you look for in businesses to buy now?
It could give you an incredibly short answer to that. It's growth prospects and a management group that want to grow.
What does growth prospects look like? Is that just them having a plan? Do they need evidence? Do they need some sort of revenue proof that they're on their way? Or are you happy to jump in before any of that exists?
It changes by company. If you take Ryman, for example, that was an easy growth plan to look at. You know, they built retirement villages. They had enough capital to recycle that money into the next retirement village. What we did was we put an amount of money in which allowed them to build 2 retirement villages at a time. So that doubled their growth. So that was an easy equation for John and Kevin to make, and it was an easy equation from us as well. There are other companies who want to expand to Australia, for example, and most of our companies are trans-Tasman, not all, but most. And we're very good at investing in Australia, and so that is often a very easy thing for us to work out and for them to work out. This makes sense to move to us to grow into Australia, and here's the capital, and we'll start in Sydney or Melbourne or whatever it is. And some other companies want to buy their distributor or buy a competitor or merge with a competitor, and that's an easy thing to plot as well. But there are also companies that just have a business, it's a good business, they might be a manufacturer, and it might be as simple as just doubling the manufacturing, which might mean building another building on the neighbouring site, which allows you to produce twice the amount you did. So it's those in different individual circumstances.
Ultimately, you're attracted to ambition above all else.
We call it growth. Ambition is exactly. Companies who have the ability to grow and people who want to make them grow.
You don't just want to make these businesses bigger though. You also try and make them better so that ultimately you earn a higher value for them when you eventually do sell them. How do you do that? How do you make a business that's already pretty good because you've invested in it better?
We won't spend money for the sake of it, and nor will our company partners. And these private company owners are very savvy business people. You know, I think the bulk of business expertise lies in the private company world. And look, that's because there's more of them. You know, we've got a smallish stock exchange and we've got a very large private company sector, so it makes sense that that's the case. We won't grow for the sake of it, and nor will they. So if we're doubling the production, for example, we want to see some efficiencies, and so do they. And so it's an easy thing to work out. We don't want to grow unless it's profitable growth, and then also as you grow, that profit margin multiplies rather than contracts as you do it.
So if we can talk about some of the businesses that you've partnered with, that you have on your books at the moment, incredible businesses. Bayleys Real Estate, which I believe you've gone back into, you've reinvested in that?
Yes.
AS Colour, I mean, phenomenal New Zealand business. I don't think most people actually recognise how incredible that business is that Larry's built. Wet and Forget. Can you tell me a sale price on the latter before we go into the ins and outs of each of them?
We invested into Wet and Forget. There was a US managers in that business. The New Zealand, the people that owned the New Zealand business sold out, and that is I know is a very famous business in New Zealand, but it's about 75% US based.
Is it?
Yes.
Wow.
Yes.
So it has a massive growth plan, and that's where you saw potential.
Exactly. Hey, look, you got it right. It's a very small player in the US in a very large market, and you know the management have got incredibly developed plans to grow, and the US is a really obvious place to make that happen.
And what does that look like inside AS Colour and Bayleys Real Estate? What are their growth plans?
Actually, it's Mike Bailey that talked about profitable growth. We don't want growth, we want profitable growth, and I've stolen that term off him for years now. So they bought a business that looked very similar to Bayleys in Australia, and it's called McGrath Real Estate. They bought it in joint venture with the McGrath Management and Knight Frank, the big UK global real estate agency business. And so that Bayleys are very large in New Zealand, upper end of residential, very prominent in farm and very prominent in commercial and industrial, and they've got a big valuations unit as well. That company replicates them in the in the residential market in Australia. If you ever go to Sydney or Brisbane, and a lot of the top end houses have got a McGrath sign outside them.
And they're higher valued houses if they're in Sydney and Melbourne. So there's a bigger feeder clip for a real estate agency, right? So the potential for an Australian acquisition is huge.
Yes, it is. And look, it's a company that Bayleys management have known the McGrath management for a long time. It was a very good opportunity for Bayleys, and we invested back into them to help them fund that acquisition.
Amazing. And AS Colour? Tell us more about that.
AS Colour, well, hey, I'm pleased you know about AS Colour, because a lot of people think it's a retailer. It's
not, it's a B2B.
It has garments made that is very suitable for being printed on. That's a very big oversimplification, but that's what it does. It has enormous warehouses in New Zealand, in Melbourne, in Los Angeles, in North Carolina, and in the UK and Europe. So it's a huge business, and we're particularly proud of that. A doctor's son on the North Shore has done this and bootstrapped that business to an incredibly successful global business, and we couldn't be prouder of that one. And that's a business that doesn't, when you talk about growth, it doesn't buy another business. All it does is open up in new geographies and offers the same product, which is very much in demand and unlikely to ever. That demand is unlikely to disappear. It's a garment in it.
So in all of these instances, how has it come around that you've invested in them? Have they come to you? Do you knock on their doors? Do you have to convince these owners of these businesses to sell for decades? How does that work?
In round numbers, about 1,000 private companies in New Zealand that we really like. And
Go on, give me the top 10.
No. And we make it our business to go and visit them as often as we can. Like they know who we are and we know who they are. We put an overlay on that. Some of those companies just want to stay as they are. Some of them have got enough cash flows for them to grow on their own, and some of them are comfortable about moving offshore on their own as well. There is another group who go, no, I'd quite like a partnership in this. And look, I am going to grow offshore, and I probably would like some more help on some of the areas that I'm not good at. And for us, that's often like people or banking or some of those sorts of roles. But so we're a supportive partner for them. And some of them will come to us and say, I have been thinking about this and I would like to push go now. And we go to them, and we go on car trips around the country, and we go to them and just usually call in and see them. Some of them go, yep, if we're interested, we'll definitely get in touch with you. And some of them go, well, funnily enough, we have been thinking about that for a while now. AS Colour itself, since it's one of your favourites, it was actually our banker that said to us and to Larry, I think you two would get on, and you've got good growth plans. Why don't you? Now that company didn't need money, but I think it was the partnership aspect in that situation that led to the transaction. And we're about a 30% shareholder in that business.
Amazing. I can imagine though some business owners tell you to politely bugger off in some instances. We've spoken about all of the success stories, but you've been in this for a long time, and I'd love to hear some of the more war stories. Like, not all deals go well, some fall over, perhaps you don't agree on price always. Can you take us inside some of those stories?
Sure. When we first started this off 30 years ago, it just didn't make sense to some people, but now it's so common. So virtually nobody says we don't want to meet you anymore. You know, you might meet them and they're saying the time's not right or something like that, but virtually no one. Well, you know, why would you? It's probably a good information base for them. So, but things generally go right in this industry, and why do I say that? It's because you become a partner with the people that own the business at the moment and the management, and things go wrong in that company. But we're not just, you know, the other owner and us are not just passive partners. You know, if something goes wrong, we have an ability to go in there and try and help it out of it, or put some more capital in, or, you know, so you don't have many disasters at all, actually. And I'm not saying you don't have any, but you don't have many. And most of them you can fix. The partner we're in is usually the industry expert. Sometimes we're the financial expert, and a combination of those things plus tenacity is usually the medicine. And funnily enough, the companies that have got into difficult situations that we've worked together and succeeded in, they've been great partnerships. You know, because a lot of people go, "Are you just there for while the times are good?" And it's good for them to see when times are bad that we're a partner that doesn't run away and move on to the next one. We do actually go and help.
Can you give me an example of where your help has been required?
Yes,
rather than just capital?
My next meeting after you, funnily enough.
Oh no! I feel like we shouldn't talk about it because it's a bad omen.
No.
Can you give us an inclination as to the industry and the challenge that they're going through, or is it business specific?
Situations change. Some industries change, the dynamic in the industry changes because some big global group comes in or sells out. On other times, it might be just a merger of another group that changes you. Now, that happens. We want to be that momentum player. We want to be the party that's merging with another company, or opening up a new office in Nelson or Christchurch or Sydney or Melbourne. So we want to be in the momentum player in that industry. But sometimes things change because governments change a rule. You know, you sort of see that you see that in New Zealand with things like the ETS scheme, where some businesses have budgeted and planned on things being in place, and to have something structurally change can create difficulties. I mean, you see that in the energy market in New Zealand. You know, and I'm not throwing blame around here, but the fact is, the last government stopped the creation of energy, and the current government haven't controlled supply or pricing. And for big industrial businesses, energy is just a thing that the governments must ensure works in a country. And
if you're paying the bill, you expect them to turn on.
That's exactly it. And so, you know, and there's some sort of chat in Wellington that's a business risk. You know, it is not. Industry needs electricity at a globally sensible price, and I'm afraid we'll sort of pay this price in New Zealand as a result of that. Those big industrial groups, energy is a huge part of their cost base, and they need to go into countries where that is an under control situation, and it's not here. The other sort of problems you have sometimes are people problems. Mm-hmm. And I can talk freely on that because that's one we can almost always fix up. And this was one in our early days. There were 5 owners in this business, and as it turns out, only 3 of them wanted us to become partners in the business, and the other 2 didn't. And so those 5 fell out drastically, and we ended up sort of being people referees as a result of it. So look, all of those. Or some of those probably happen sometime over our hold period, because it is, you know, we do have a long hold period, and industry will change, people will change, the market will change, and so it's business as usual for us, and we don't lose sleep over it. We just get in there and help where we can.
The fact that direct capital though has had few actual deals go wrong, so it sounds like from this conversation, do you think that's because the equity and the capital is coming from investors that you raise money from, not through the likes of leveraged buyouts? Is there something structurally about the way your firm works that means you have more success?
Yes, there is, and about the industry. For the leveraged buyouts, as you point out, that adds an enormous risk. you've got a lot of debt in that business, and if you have one of those fluctuations, you don't always have the financial capability to get through that. And that's why those offshore leverage buyout funds, they do have quite significant disasters, but it works for them because they have another two that actually, you lose your money once in that business, but they make 4 or 5 times their money in another business. So that's a business model that works offshore. It doesn't work here. Private company owners don't like a lot of leverage, and they're not, they're owners in the business after we invest. The leverage buyout people often buy 100% of it. So none of our sort of company partners are up for that level of risk as a general principle. So that aside though, the reason you don't have many disasters is both the private company partner and us have a lot of time to get to know each other during due diligence. And in the private company markets, it's funny, you in the public company market, if you get inside information and you get very valuable information on a company and here's this big risk or here's this big opportunity, the law says you're not allowed to buy a share in that company. And in the private company world, you go in there and find out all of those things and then invest. We wouldn't invest unless we had inside information. And in the public company markets, it's
illegal.
It's against the law. Yeah. It's a funny situation, isn't it? So nothing should surprise us in the first year or so of our investment into a company because we've got to know the owners and the partners. We've got to know the management, and we sort of know the industry well, and we've done good due diligence on the business. So there aren't as many surprises as there are in the listed company market.
What's the average time from the first discussions about a deal to the deal actually happening? What's the average sale time in this environment? It's years, right?
Hey, I was going to say, including the courtship, it can be like 10 years.
And how much money do you spend over that period? I mean, like taking them out for dinner and winning them over.
No, it's more visiting them in their locations or us, and we're in that city anyway. We're in Hamilton and we've got a meeting for half a day. We'll always go and talk to some other people there, or Christchurch or Wellington. So, but I think your question's based on once they say we'd like to do something and we say we'd like to do something, the very, very shortest it would be 2 months, and it's quite often 4 months.
I'm keen to talk to you about private equity as a market and where it's at currently in this environment. Interest rates are lowering. They're still relatively high, considering the past few years. That obviously impacts valuations and what people are willing to sell or you're willing to buy for on price. Talk to me about that at the moment. One
of the good things from an investor's point of view and from the company owner's point of view is it's not a volatile industry. Where on the stock market, something happens and you quite often see the value of the share drop by 10% and over the next month go up 12% and things like that. That doesn't happen in the private company market. As I say, these people that own the businesses are, they are clever, seasoned business people. If the market dropped 20%, they simply wouldn't transact during that period and they'd wait till it's there. But by the same token, if the valuations have shot through the roof on the public company markets, someone that takes a long-term view like us, we probably won't invest at those values. What we're both trying to do is say, what's the long-term, the 10-year value of this business? What's the 10-year growth trajectory of this business? And as a general rule, if you're talking about 100, we might come up with 40 and they might come up with 60, and that's an acceptable range to negotiate. And it is just a negotiation from then on, because there's no absolute benchmarker out there usually. This is a transaction in a private company business, and quite often the last share transaction in that business might have been 10 years ago or 2 or 3 years ago. So it is a negotiation. Everyone does it in good faith, because there's no external marker. Everyone does it in good faith. It does work. It sounds funny and it sounds clunky, but it does work.
Well, on that point, if you can't mark the asset to market like you can on a public market, how do you know that you're paying the right price? Or that how do they know that they're selling for the right price?
Yeah. Hey, well, that's a private equity myth, actually. You can mark, and in fact, when we raise institutional funding, we must value that every quarter, and for some investors, value it more regularly than that. There are international rules out there on how private equity funds value a business, and they're very well set. They're pretty much the same all over the world. They've been in place for a long time. So institutional investors get a valuation every quarter as a minimum, and that valuation gets audited, by the way. So there are markers, and most institutions need that. And by the same token, the private company owners, once they look at a partnership with us, we do make that investment. When we're looking at other growth possibilities, like a merger or like opening the factory, as I said, they and we are quite interested in what the value of that would be if we did that, didn't it? So we do these projective valuations as well and decide whether we will take that growth initiative or not. It might say there's something that needs 30 or 40 million, but it doesn't seem to affect the value a great deal. So you don't do it. So we're both continually looking at growing shareholder value. That's our measure, and their measure is, if you buy a $2 share, it'd be great if it's an $8 share in 10 years' time, and pay a very good dividend on the way through as well.
Okay, so there is some degree of valuation transparency.
Yep.
But what about liquidity, Ross? I mean, it's almost non-existent in this market. You hold on to investor funds for years, decades in some instances.
Another myth.
Okay, knock the myth. Expose it for me.
Okay, well, there's two myths. One is if you invest in a private equity fund, there is quite regular changes in ownership in that fund,
Between the investors,
yeah.
Secondary,
exactly. Sometimes it's third parties, but it's in our funds, it's always been taken up by existing investors. The liquidity myth that I'm talking about is that you're talking about the difference between the private and the listed company market. Here's a way to look at it. Our shares are more liquid than the types of stakes we would take if they were listed companies.
Because of the size of them?
Because of the size of them. So, like in the listed company market, you can buy up to 20%, but you can't buy 21%. And you can't buy 40%. And if you buy 50%, there's another set of rules. And if you get to 75%, there's another set of rules. So the private company market has none of that. And in the listed company market, you quite often need a regulator or the stock exchange to say yes or no to it. You sometimes need a third-party advisor to say whether it's fair or not. In the private company market, it's a contract market. There's a person who owns a company and is, say, allowing us to inject capital into it so that we own a 30 or a 60% share in that business. That's a matter between that party and us. And there's no other party telling us whether you can buy that stake or not. There's no party saying you can't buy 48 or 51.
There's no referee.
There's no referee. It's purely a contractual thing. And when you sell it, it's the same thing. If you've got a 40% shareholding in a private company, you can sell that business. You've got the same in reverse when you're selling it if you've got a listed company share. They both work, but I'm just saying it's probably quicker and easier and cheaper to sell a private company asset than it is to sell a listed company asset.
And so you're telling me that it's actually more efficient to plan private markets than public markets because the layer of rules now in public markets has made it so inefficient?
Yeah, I'm making it provocative. I think they're both liquid is the really point.
But you'd rather play in private.
we know it. We know it, and I think the main reason we want to invest in the private company market is it's so huge. We find the people in it great people to partner with, and the way we invest, as I say, we invest on a fully informed basis. And it quite often annoys me when I read something about a listed company saying they've invested in something and the price is confidential. None of that is at play in the private company market. We can say everything we want to each other, and we do.
If we look globally at the trend of PE, according to Bain & Co, who do an awesome report every year, we've spoken about this before we came on camera, it's one that you read frequently too, all-time low for deal volume, deal valuations, in total we're down 37% last year in 2024. Is direct capital a net buyer or a net seller in this environment? Like, what are you thinking about going forward? Is this the year of buying or selling, Ross?
Well, we invest for a very long term, and we invest in these cash flow businesses that pay good dividends. So we never have to sell, which is one of the great advantages. We have. But what we quite often do is give a right to our partners if they want to sell to take our stake along with them, and that happens quite a lot. You know, like a trade buyer will usually only buy 100% of a company, not always. So we are investing and looking at other alternatives like floating or something like that in different companies at different times. So we, there's not a great market for us ever in any one point in time because we're doing both. And but I think the main issue is we need to be in those companies for a reasonable period of time to execute those growth plans. And the valuation discussion we had is relevant to this. If there's a screaming market, private investment companies often don't buy businesses, but they will invest into them. And that Bain & Co report, I think, says that it doesn't talk about valuation. It talks about the dollar value of
deals.
Of deals, yes. And last year, you're right, it's a low year, but that's private equity across the board, including those leverage buyout things. In fact, we had a very big year for us. We invested in 4 new companies last year, and the year before I don't think we invested in any. So,
is that because valuations were so high the year before that you sat on your hands?
It was a bit, but the main thing was when the market was booming, some of the advisors would try and make you do a deal within a month or a month or two.
Put the pressure on.
And allow you to speak to management for an hour and a half in a.
That looks desperate though. That makes you not want to buy it,
in
right?
an office, yeah. We will do those types of transactions, but they're not the ones we seek out. We seek out the ones where the private company owner gets an advisor and we talk bilaterally, and no one's going to do a silly deal on their side, and no one's going to do a silly deal on our side.
The reason I ask about forward-looking deals is because apparently firms are globally sitting on billions of dollars of dry powder. But given you did 4 big deals last year, are you still sitting on some dry powder, or have you allocated it all and you're just operating businesses now?
We raised a new fund in November, December last year. So we've both got companies that we're working with, and we've got new companies that we'll be investing in with the new fund as well. I should say, I often see that term dry powder in the private company market. There isn't much money for the private company market globally relative to the opportunity set in each country. You often see there's billions or trillions of funding available, but there's billions and trillions times 2, times 10 of opportunity. And it's the same in New Zealand. Like if all of the private company people wanted to raise capital at the same time, this country doesn't have that money.
Can you give me that ratio? What's the dollar value opportunity versus the capital available? What's the times?
Well, I'm saying, there might be $2 billion of private equity capital available in New Zealand, but the demand may well be sort of 10 billion, or I'm just saying it's that relativity. It's not the absolute amount of money that the private equity funds have.
I find that really interesting. Have you seen that opportunity in private markets only increase, hence why you felt the need to raise more?
Yes, the private company market was big when we started 30 years ago and still is. The number of people in those private companies that are prepared to do partnership deals has grown exponentially as I've seen it work for their friends who've done it in another company. So that the opportunity set gets bigger and bigger, and it's great. And more private equity funds have come into play. So it's a really good, healthy market now.
Is this the end of public markets, perhaps then?
No, not at all. Public company markets will always be in existence and will always be good. it would be great to see I suppose from our perspective, it would be great to see the New Zealand public market being bigger, first of all, and growing. And some of the private companies would love to have that opportunity to grow, to have the business themselves, grow it and list it on the stock exchange. We just haven't got enough of them that are wanting to do that at the moment. And I know both the FMA and the stock exchange are working hard on it, and that's a great thing to be doing.
With all respect, aren't you the problem in that equation then? Like, isn't the growth of private equity firms and the more capital you're raising, which is fantastic for you and your industry, but isn't that what's inhibiting companies from listing? Because they'd rather come to you, and they can, because you've got the money to throw at them.
No, there's actually companies that want to list as well, that go straight to the stock exchange.
I'm yet to see them. I haven't seen one for a good few years.
No, look. There are many great businesses in our 30-year period that we have visited, wanted to invest in, and they chose listing. So no, I think just capital is all you're looking for. You can get capital many different ways, and I think all of us are symbiotic. Actually, I don't think it's particularly competitive from the listed company side, or the private company side, or the trade buyer side.
On the fund you just raised, can you give us an inkling as to the industry or business that you're likely to invest in with that money?
We do some of that, but really what we're looking for is companies, it's back to the same thing, companies with good growth prospects and the management that want to do it. The reason we don't single out an industry, for example, first of all, we're not allowed to. We're not allowed to concentrate all the industry in, say, some infrastructure services or something like that. But the reason we don't focus on an industry is as I say, you're taking a 10-year decision, so you can't analyse an industry for 10 years probably. So you're just looking at the ability to run and grow the business at the moment.
When can we expect an announcement on a business that you're partnering with?
We, for the first time in our career, took a good break over Christmas this time. So I would say in the first half of this year.
I look forward to it. Thank you so much for your time, Ross. I really appreciate it.
You're welcome. Thank you.
Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.